All right, welcome back to Yahoo Finance Live on this Thursday morning. We're just about 30 seconds out from the opening bells. We've got stocks coming off of record closes. A little bit of a mixed picture for futures this morning. Of course, we've got Jackson Hole kicking off. We've already heard plenty of Fed speak within the last 12 hours or so, and we're going to hear, of course, from Fed Chair Jay Powell tomorrow morning, 10 o'clock Eastern Time. We'll have those remarks for you live here on Yahoo Finance. Globin ringing the opening bell down on the floor of the New York Stock Exchange as we get today's trading session underway. Almost wrapping up the final full week of trading in August, Friday Eve, as we say here around these parts. And we'll see how things shake out as we get to and through today's trading session. But let's stay on the Fed and talk a bit more about the economy and this week's Jackson Hole Symposium. Jim Caron joins us now, fixed income portfolio manager at Morgan Stanley Investment Management. Jim, great to have you back on the show. I'm curious just how you guys have thought internally about the importance of this year's Jackson Hole. We've talked about it on this program, certainly at length. And are you viewing this as a time for the Fed to really signal new intentions, or might that be waiting for the September or November FOMC meetings?
Thank you for having me on the show. No, I think this is a very important meeting, and it's going to be one of these cases of, do as I say, not as I do in many ways. So really what I'm saying is that the signaling and the messaging around what goes on at Jackson Hole is going to be most important. So I think that Jay Powell will talk about tapering. It's a question mark whether or not he sends a strong enough hint, whether that the official announcement comes in September, or if the official announcement comes sometime later, let's say like in November. But the point is that the tapering isn't likely to start until later this year or the beginning of next year. And we still think it's going to be about 15 billion per month of tapering, meaning buying 10 billion less U.S. Treasuries and buying 5 billion less mortgage-backed securities out of the 120 that they're currently buying per month right now. So it's a step in the right direction, but I do think it gets discussed. I just am more concerned about the signaling and the messaging that's around that, and then what the later impact might be on the market.
And Jim, tapering at that pace, like you just mentioned, what does that mean to the fixed income markets?
So it's kind of interesting, right? Because it becomes very counterintuitive at this point. So one would think that tapering, like when we had in 2013, the taper tantrum, that would be a very negative thing. But that's not what the markets are actually saying. What the markets have been saying is that if the Fed starts to remove excess accommodation too early without allowing the real reflation to begin and rebuilding of term premia into the yield curve, then effectively, if they taper too soon, then they won't be able to hike rates as much later on, which means their terminal Fed funds rate will be lower, which keeps 10-year Treasury yields lower today. So weird, right? Tapering might mean, an aggressive talk on tapering might mean that 10-year Treasury yields really don't rise that much, or actually even start to move lower, because it shows a policy mistake. On the other side of the equation, if the Fed does postpone tapering, doesn't taper as soon as the market thinks, then what the market believes is that there will be more reflationary pressures built into the economy, and that will allow the Fed to hike rates more later on, which raises the terminal Fed funds rate in the distant future, which could cause Treasury yields to rise even higher. So one of the reasons why 10-year Treasury yields, in our view, has been moving higher is that we expect there to be a softer message around tapering. This has invited some of the risk-on characteristics to come back into the marketplace, but it also effectively raises the terminal Fed funds rate in the future, meaning that the Fed can hike rates more later on, and that actually puts upward pressure on 10-year Treasuries. So this is completely counterintuitive, but it's really a question of how this gets signaled and how this gets messaged.
And of course, everything could change between now and when they actually start increasing rates. It did catch my eye this morning that Bank of America, your peers over at Bank of America, cut their year-end forecast for the 10-year yield to 1.55%. And I wonder how that matches with your, it seems like that might be in line with what you're talking about. But I would also ask then, what would be your longer-term yield forecast given the scenario that you're painting?
So we look at it in three ways, right? And effectively, we have a base case, a risk case, and on the upside and on the downside as well. If we think that the Fed will ultimately hike rates more in the future, meaning that the terminal Fed funds rate, that the Fed eventually gets to a 3% policy rate, then that would argue to me that the 10-year Treasury today should be about 2%, a little over 2%. If we think that the Fed is going to, taper too soon or remove accommodation too soon, then that will lower the terminal Fed funds rate to about 2%, which means that the 10-year Treasury yield fair value today would be around just under 1.3%. And what we think is that the truth is somewhere in the middle, that the Fed does get to what they've already discussed as their terminal policy rate of 2.5%. This would suggest that effectively the fair value for 10-year treasuries is closer to about 1.7%. So I guess, to answer the question more directly, I would argue that by year end, I would expect the 10-year treasury yield to be closer to about the 1.7% level, versus where we are today. So I would view yields today as being too low.
So, Jim, I know you're a fixed income guy, but I have to ask also, do you think about the repercussions for stocks then of the scenario?
Yeah, so I think equities function on cash flows and growth rates of earnings, right? And cash flow is going to be something that becomes directly correlated to GDP growth. GDP is effectively the cash flow of the entire economy. So we expect GDP growth to continue to be relatively strong this year, and also next year. And then the question then is, do profit margins stay wide enough such that the earnings growth rate can continue to demand a multiple in the market? So effectively, the tapering, it might have an initial impact on equity prices, in my view. And again, I'm not the equity expert, but the way that I think about it is that tapering, I don't think is going to have as much of an impact on equities, just because essentially I don't think the tapering is going to reduce the GDP outcomes or expectations, and therefore it probably will not have as much of an impact on earnings. So just from that very, very narrow lens, I don't see this as a very big negative for equities, although, if there is a big tapering announcement, clearly maybe on that day. But I think over time, I don't think it's going to have as material of an impact.
All right, we'll leave it there. Jim Caron, fixed income portfolio manager at Morgan Stanley Investment Management. Jim, always appreciate the time.